Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Today, I'm joined by Tuur Demeester from Adamant Capital. Before Adamant Capital, Tuur was the editor-in-chief for Adamant Research, a global macro investment research firm. In this episode, we're going to be discussing investment strategies for accumulating Bitcoin and generating returns against Bitcoin. While most investment strategies focus on generating returns in US dollars, Tuur focuses instead on generating returns in Bitcoin, and he measures his success against Bitcoin. Of course, if you followed the growth of Bitcoin over time, you'll note that this makes for a much higher bar in terms of returns for an investor. While I won't comment on Tuur's fund specifically, I should mention that there is a growing number of crypto fund limited partners looking for funds denominated in Bitcoin and which charge fees based on returns in Bitcoin as well. Tuur's general approach is in line with this philosophy. This two-part deep dive is broken up into 4 chapters. In chapter 1, we explore why one would invest to accumulate Bitcoin rather than USD. In Chapter 2, we discuss how Bitcoin accumulation investment methods differ from methods for generating returns against the US dollar. In Chapter 3, we consider the methods that one might use to invest for Bitcoin accumulation. And finally, in Chapter 4, we close our conversation with Tuur's unfiltered thoughts on Ethereum and his take on the future of Bitcoin. In this segment, which is part 1 of this 2-part series, we'll be focusing on Chapters 1 and 2. Part 2, which comes out next week, will provide chapters 3 and 4. We'll get to the episode in just a second, but before we get started, I'd like to pause for a moment to tell you that this episode is brought to you by Nexo. Here's a word from them. Nexo is the world's largest and most trusted crypto lender, offering automated instant crypto credit lines which allow you to use your crypto, for example, Bitcoin, Ethereum, or XRP, as collateral to get cash in over 45 fiat currencies and stablecoins without selling your crypto assets. Nexo also offers interest-earning accounts yielding up to 6.5% per year for stablecoins and euros. Interest is paid out daily, and you can add or withdraw funds at any time. Nexo is also a strategic partner of exchanges, OTC desks, traditional and crypto funds, helping them earn interest on idle stablecoins and fiat. The company's growing portfolio of structured institutional products includes fully collateralized, continuously rebalanced swap agreements, allowing counterparties to effectively manage their balance sheets. Check them out at nexo.io. This episode is also brought to you by the Nomics API. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, or if you need historical CSV dumps of trading data from top exchanges or even obscure ones, then consider trying out the Nomics API. Our API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your developer have to spend too much time cleaning up and maintaining datasets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomicsapi.com. Finally, if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to our regularly scheduled program. Here's part 1 of my conversation with Tuur Demeester from Adamant Capital. Enjoy. Before we dive into the big conversation that we're going to have around investing for Bitcoin accumulation, I think we'd be doing a disservice to the listeners, without discussing a little bit your origin story, both with regards to your involvement in the Bitcoin community and the cryptocurrency community. Could you share a little bit of your path with us?
My initial interest was philosophy, and then from that came philosophy of law, which is really the study of what does it mean to have order in society, and what is just and what is right, those kind of questions, and then really applying it throughout history. That's tied into economics too. Like there's this intersection between the two. So I started studying business cycles. I also did translation work there. I founded the Rothbard Institute in Belgium. Co-founded. We came together starting in 2005-06. And then eventually I was more and more intrigued by like, well, how do I apply these ideas for myself? Because like as I was diving into financial history and the history of banking in particular, I started becoming kind of scared at how fragile things were. And then, 2007, the rumbling started of this credit crisis. So eventually I decided like I was going to dedicate a lot more effort to trying to figure out how to stay safe, how to invest intelligently, having this knowledge of the financial system. And so the kind of basic truth that I still hold and that I think discovered back then was that in order to be protected during a serious financial crisis, be it a deflationary or an inflationary crisis, where you want to be invested in is in liquid assets with low third-party risk. And so that's how I became a gold aficionado starting in about 2007-08. But I kept looking for something, like I wanted to find things that were out of the box, because history never exactly repeats. Like it rhymes, but it doesn't exactly repeat. Is the answer really just gold and gold mines, just like in the 70s? I was traveling in Latin America. Part of that was really to figure out, like, is there going to be, if there's a big euro crisis, maybe I want to be more mobile and I work online anyway. And so that's how in 2011, I discovered Bitcoin in Argentina. Friends of mine were mining Bitcoin in Buenos Aires, and it was just the perfect introduction. Like, I feel like I was just lucky that my mindset was there. I was already focused on, the investment side of things. I was already writing my newsletter. So it was just really the perfect introduction.
I came to similar ideas through a similar path. I read, I read your report. I read James Rickard's book, The New Case for Gold. It's really unfortunate that he doesn't seem to be a huge fan of Bitcoin. Given that the entire time I was reading his book about gold, I was just thinking about Bitcoin, but also became excited about gold back then. It definitely does seem like you have this philosophical bent and, proclivity that just happened to work out for you in a pretty economic way, or was it not an accident at all? Have you always been pretty interested in money and the accumulation of wealth?
My interests have been more about personal freedom, and it's only gradually that I discovered that, in order to really be sovereign, it's important that you take care of yourself financially. So that only came gradually as kind of a byproduct of really yearning for complete independence and freedom. There was also this element of fear in 2007-08. What if I'm stuck here in this country, for example? What if I'm stuck in Belgium for the rest of my life? And what if I, won't be able to afford the kind of education I might want to give my children or things like that? It's really that. And then I just love the challenge of trying to figure things out that are highly complex, and the markets are just ever changing, and it's basically the whole of society that's taking part in them. So it's endlessly fascinating to me.
At what point did you decide that you wanted to transition from being personally interested in this space to taking a leadership role, writing up reports, sending out newsletters, sharing as you do on Twitter? What was the impetus for making that switch?
That definitely was a conscious decision, although I did already have a newsletter in Belgium. Like a lot of my writing, I think I wrote about 8,000 words on Bitcoin investing before the price was $30. That was all in Dutch for my subscribers. And so I was already doing that, but really the main motivation was just finding ways to connect with people in the space and finding ways so that the people that I admired could possibly become peers over time. And I'm just I feel so privileged and excited that the kind of quality people I get to talk to. There's this round table of comedians that I saw like maybe 2 years ago. It's like a 1 hour recording of Ricky Gervais and 3 other guys. They're talking what motivated you to want to become a stand-up comedian. one of them said like, well, I just wanted to be one of those guys. Like I wanted to, be part of that club of cool people. So it's pretty much the same for me. Like it's like, and obviously I want to contribute, to the space and do things that I think are just not being done yet, right? Just to offer something that's hopefully new and valuable.
So you started off, the moniker I saw was Adamant Research. What was that really back then? Was that just sort of a name to put on the reports you were putting out? Were you doing independent or freelance research for investors? What was Adamant Research?
It really was a brand that I was just exploring, and I wanted to have something that was independent from my name that I could grow, but that at the same time wasn't bound to one particular asset necessarily. The name Adamant, I liked it because it was this, there's this adamantium metal in the X-Men universe, and it's extremely strong, and then there's obviously the whole Wolverine character, which is kind of, headstrong, but at the same time, just very passionate, you could say. So it's just something that I wanted to build, and I didn't really know what I was going to do with it. Initially, it was those reports, and I also did bespoke research. I started it when the market was totally dead, like 2014. There was just no interest, let alone institutional interest. So I was just kind of starting something, and I'm glad I did because it's been 4 years now. So we have that name out there now.
What became of your explorations around freedom and sovereignty and perhaps, location independence, working from anywhere? Have you put those on hold to go full time in Bitcoin, or are you pursuing those interests still with the same level of vigor and enthusiasm as you are the investment stuff?
Yeah, I definitely have a bunch of plans up my sleeve still. For now, I'm in the US. I just love the US. It's such a huge market. I see it as a continent. It's not really just a country. It's so big. There's so many opportunities here. And I still have, kind of the European experience. I still have my Latin American experience in my back pocket. So, but in terms of, just the combination of stability and opportunity, in my mind, nothing beats the US.
It's interesting to hear you say that. I definitely run in some circles that often see this country as sort of one of the worst places to live in the world, in part because of lack of social safety nets, the state of our healthcare system, our current president, various interventions worldwide. How do you reconcile those things with your experience here?
Yeah, it's always a topic of debate and discussion. And then, like, first of all, I don't think there's something that fits for everyone. Like, different people have different preferences, and it may very well be that other people just, find better fits for them elsewhere in the world. It's such a big world.
Yeah.
This just happens to be a fit for me at this moment. One thing that I would say to people that don't live in the US or that do live in the US but haven't really been around very much in terms of seeing different places is that it's not homogenous at all. Like it is a very rich continent full of different cultures and regimes and approaches to taxation. And I think it's better to look at it state by state rather than to kind of say, oh, this is the US and these are the statistics for the US. I just love how entrepreneurship is celebrated around here, how dynamic it is immigration wise. Like there's always people that come from different backgrounds. There's lots of mobility within the States. Like in Europe, for me growing up, like it was a big deal if you moved from Bruges to Ghent, which is like 50 kilometers away. The mobility is totally different. To me, I just love that about the US.
That's encouraging to hear. I can sometimes get a little bit down on this.
The grass is greener, right?
Yeah.
I think that's where travel really comes in. If you travel with a critical eye, you can often really appreciate a place and love what it has to offer, but still think, well, what would it really be like to live here? Would I want that? If you have the means, I would encourage people to try a few months living in a particular country that you think you might like. Because right now, there's so much remote work that we can do. So many things that can be done remotely that really means that people can choose very freely where they want to live.
I wish there was more of a free market around location and citizenship and things like that. I think it behooves any country to try and just brain drain the rest of the world and have all the smart people move here. So it's a net positive for us that you moved here. I'm glad we attracted you to this space. Hopefully we can keep you. as someone who's invested here. But man, I think part of what is going to happen with the decentralization of money is a more competitive environment around things like citizenship.
Crossing borders, as a refugee, it used to be very, very hard to carry any financial goods with you. Like there's these stories of Hungarians sticking gold coins in their shoes and Jews sewing diamonds into their jackets and things like that. That's incredibly inefficient compared to like a Bitcoin brain wallet or something.
Yeah.
So I really do think that as Bitcoin grows in adoption, it's going to enhance mobility for a lot of people.
Hopefully it'll make states desire to be more competitive. Like, right now, if we've got if you think of money as a means of exchange, unit of account, and store of value, if you own sort of, the world's quote currency, you can just print some more. That's a really terrible place to be. Whereas if we had to be a little bit more marketing ourselves and soliciting wealthy people and, sort of the things that actually generate capital locally here, I think that's a good thing. We'd just be a lot more dependent upon attracting wealth rather than, depending on the printing press. Let's cap this off by learning a little bit about Adamant Capital and your transition from Adamant Research to Adamant Capital. When did you decide you wanted to go pro and not just do this stuff for yourself, but that you were going to do this on behalf of others?
I don't want to talk about it too much
Sure.
because I don't want to be soliciting publicly. That's not the purpose.
Right.
But in terms of motivation, it's just something that is an extension of what I've been doing for myself, like my own investment activities. For me to take it to the next level, it allows me to build a more refined machine to execute these strategies. And to me, it's it would either be that or it would be like a financial newsletter. And I felt more drawn to something like a fund because I felt like it was more of a challenge and also a slightly different audience that I would be addressing. And then there's also the whole skin in the game idea that in a fund, it's really your own money that you're putting at work and other people's money, of course, too. And there's this accountability. And part of me is drawn to that just being held accountable by reality in the market and of course, performance.
That makes sense. Plus the content business is just like this hamster wheel of death. Like, if you write a good report, a fantastic report, it seems like when it strikes you and when you're inspired, you don't have to churn out content daily, to make ad revenue.
I think that it's probably different if you write for institutions, but it's true. There are different dynamics at work. It's very challenging to write for a retail public because usually, the newsletters that do best will tell people what they want to hear, which is usually when it's too late. So there's this kind of perverse, incentive structure there.
Let's kick off chapter 1, which is an exploration of investing for Bitcoin accumulation. Why would one want to invest for Bitcoin accumulation? What are the philosophical underpinnings of this? Why do this?
To me, this fits perfectly with this little book that I read as a college student, which was The Richest Man of Babylon. I think it was originally written in the 1930s. And it's just this very basic approach to investing. It's basically this laborer who talks to like a wise man and who learns from him the secrets of investing, which is that you want to accumulate more gold. And how do you do that? Well, you put aside some savings and you put it under a rock, and those are your gold coins. And every now and then you make an investment in a business, and that will also yield more gold over time. For ages now, accumulating more money was really the way to go. So not only if you accumulate Bitcoin, do you apply, or do you pursue the same goal that people always have pursued historically with gold, but you have this tailwind, which is the fact that it's not fully mature yet. It's still being adopted. So if we go from 3, 4, 5% adoption to 20, 30, 40% adoption, then of course Bitcoin's value should be a lot higher. To me, where I come from, but of course for institutions and for family offices and people who might not have the same conviction that I have, for them it's more an asset that is very not correlated with the rest of their portfolio, an asset that has an extremely interesting risk-reward ratio, an asset that has 10 years of track record by now. To me, accumulating more Bitcoin, why do that? Well, it's better than having Bitcoin and not accumulating more. It's a very simplistic answer, but that's kind of where I come from.
Maybe another way to think of this would be, why accumulate Bitcoin versus accumulate, the alternatives, which would be fiat, right? So it does seem like there's a belief in here about, investing or accumulating in deflationary assets versus inflationary assets, or, accumulating assets that are going to appreciate in value versus depreciate in value. Is this sort of how you've always approached investing with regards to accumulating BTC versus accumulating US dollars or another fiat currency?
Like I said in the beginning, it's about accumulating assets that are highly liquid and that have low third-party risk. And the perfect example of that is hard money. Hard money is incredibly liquid no matter where you go around the world. But the challenge with the dollar is that there is a third-party risk. Like if, of course, there's the printing press, which works against you as an inflation tax and which can go rampant. The average lifespan of a fiat currency throughout history, I believe, is 27. It's so basically less than 3 decades as the average lifespan of a fiat money. You have that working against you. And then also the fact that almost all of fiat currency is held by third parties, and they can go bankrupt, they can freeze your funds. Like anybody who was there when Cyprus had their crisis in 2011 or in 2001 in Argentina, they just freeze the bank accounts. Or, some judge, even without a ruling, can order for your accounts to be frozen. There's that element of non-sovereignty, which Bitcoin does not have. Bitcoin is really sovereign money. If you own your keys, then only you can control the Bitcoin.
It seems like another advantage, which I unfortunately encountered the wrong way, is, let's say hypothetically someone buys what they consider to be a bunch of Bitcoin for them after reading your report that comes out in 2015, when Bitcoin is at 300 and then it goes to, hypothetically, wherever it was in 2017. And then hypothetically that person invests in some funds that are denominated in USD, automatically that generates a taxable event. That person is potentially in a lot of pain with regards to the IRS. Right. It seems like also there are tax advantages to, denominating in BTC when it comes to your investment activities. Would you say that's true?
I would say that you really have to be aware of the tax situation. Every country is different, but it's often the case that if you, sell Bitcoin that has appreciated, then your local IRS is going to look at that as a taxable event, and it's going to look at the difference in fiat value between when you purchase it versus when you sell it, either long-term or short-term capital gains taxes.
Hey, I want to pause for a second to let you know that this episode of the Flippening Podcast is brought to you by the folks at Nexo. Again, here is a word from them. Nexo is the world's largest and most trusted crypto lender, offering automated instant crypto credit lines, which allow you to use your crypto, for example, Bitcoin, Ethereum, or XRP, as collateral to get cash in over 45 fiat currencies and stablecoins without selling your crypto assets. Nexo also offers interest-earning accounts yielding up to 6.5% per year for stablecoins and euros. Interest is paid out daily, and you can add or withdraw funds at any time. Nexo is also a strategic partner of exchanges, OTC desks, traditional and crypto funds, helping them earn interest on idle stablecoins and fiat. The company's growing portfolio of structured institutional products includes fully collateralized, continuously rebalanced swap agreements, allowing counterparties to effectively manage their balance sheets. Check them out at nexo.io. This episode is also brought to you by the Nomics API and CSV Data Export Service. The Nomics Market Data API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. If you're a professional investor or developer and you need accurate prices or accurate history, I can tell you that our competitors' prices, for the most part, are not accurate. We're actually going to come out with a report about this soon. I should note that the Nomics API is used by many of the largest and most influential companies in the space, including top exchanges, 100 plus AUM funds, and prop shops. Hit us up if you'd like more details or go to nomicsapi.com. Furthermore, if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to this episode.
So you have to be really aware of, when and under what circumstances you might want to sell your Bitcoin. There is another approach to it where you leverage your Bitcoin rather than outright selling it, which is something that people have done very often throughout history with life insurance policies too. Like it's one thing to have a gold deposit and you can use that to borrow against it. But life insurance policies, it's not in your favor, even without taxes, to liquidate your life insurance policy. But it does have real value, so you can borrow against it. Typically, people do that to start a business or to have like investment real estate or something like that. I think that Bitcoin is going to take a similar role for investors in regimes that do tax capital gains, where you really want to only liquidate your Bitcoin if you've explored the other options and they're suboptimal to what you want to achieve financially.
I think that's something I learned the hard way as an LP in various funds, is that if the fund is denominated in USD, it doesn't matter if you are contributing to the fund with Bitcoin, that Bitcoin converts to an interest in the fund immediately in USD. If you're getting your statements in USD and your assets under management are in USD, that just triggered a taxable event.
I'm not an attorney, so people should contact their own counsel. But my understanding is that what the concept that makes all the difference is diversification. For example, if you pool real estate with other people and you keep it in real estate, that might not trigger taxes. Versus if you say, well, I'm going to contribute, this piece of real estate to a fund that's otherwise invested in totally different assets. And then, my asset gets commingled with everything else and I just get a share of the total. Well, then that could trigger, that could be considered you actually liquidating your assets. The concept of diversification is often important when you're thinking about funds and partnerships and things like that.
In the history of investing for accumulation of really hard stores of wealth does seem like a pretty novel thing to do. Like I don't know of any instances where you can like contribute gold to some kind of gold accumulation fund and then they give you back more gold than you gave them. Or with real estate, you can somehow, give real estate to a fund and then they give you back your real estate with additional real estate. Do you know of many instances where people have at scale done investing of really hard assets in the hopes of accumulating more of that asset?
This is probably a stretch, but you could say that early 20th century gold-based life insurance was a bit like that. It started in the 1850s, and the benefit doesn't accrue to you because it's a death benefit. It'll accrue to your family. If you don't get to have a full working career, then your family is going to get more gold than you initially had. Maybe the other comparison might be the kind of shift that we've seen in the stock market, where companies, instead of paying out dividends, they will buy back their own shares, which is, in a way, they're reinvesting the proceeds. So they're generating more of the thing that you tried to invest in initially. And so they grow the pie that way. And that's often more beneficial for investors because they don't have to pay taxes on these dividends. And so that's the cool thing about Bitcoin, is that it does not pay dividends. Ben Davenport recently penned a piece about something that's not very often considered by proponents of proof of stake, is that if you have a coin that generates more coin because of staking, you're probably going to be taxed on that down the road.
Hey, this is Clay cutting in from the editor's booth to define proof of stake for those of you who are new to the concept. Proof of stake is an alternative to proof of work and a type of consensus mechanism where a set of validators propose and vote on the next block, and the weight of each validator's vote depends on the size of its deposit, i.e. what is staked behind the validator. Okay, back to Tuur.
I think that, owning a coin that is just provably scarce and that is going to be adopted over time is probably a more tax efficient kind of strategy.
The SEC, recently said that Ethereum is not a security, but it does strike me that one of the things that you get with a security is dividends. And so in a proof of stake system where you're getting paid, proportionally based on what you're staking, that just seems so much like a security. And again, I'm not a tax attorney or a professional, and this is all just speculative, but so much of proof of stake earnings just feels like everything I've read about what a security is.
The Howey test is such an old test. I mean, it's like 80 years old.
Yeah.
I think the initial coin offering pretty much passed the Howey test, which, means like I think it was a security when it was initially offered. And then the SEC was slow to respond, which is understandable because it's all so new and nobody knew if it was even going to, be alive after the first few years. But then they kind of gave it a pass and said, okay, well, right now it's no longer a security. But then the big question is, like, if it becomes sufficiently centralized again because of all these bloat issues, could it be deemed a security again? Especially if you think, yeah, maybe they'll do staking and things like that to incentivize people to, to buy the token. I think that's pretty dodgy territory. Like it's definitely possible. I think that it could at some point by some jurisdictions be deemed a security again.
Let's move on to chapter 2 of this exploration of investing for BTC accumulation. How is investing for Bitcoin accumulation different than investing for, let's say, for example, USD accumulation?
First of all, it's a mindset shift. Like if you invest for Bitcoin accumulation, you really have to very deeply accept and continue to work with the fact that Bitcoin is extremely volatile. Like that is probably the biggest challenge. Because if you look at the 10-year trend and if you look at kind of long-term and the baseline of the technology, I think it's pretty clear that it's going to stay around. But, it's just emotionally, it's such a roller coaster to have years where it rallies by 400, 500%. And then there's other years where it crashes by 70, 80%. If you succeed in accumulating more Bitcoin and that, over time rewards you with more wealth, I think what you've done is you've kind of beat the market in being willing to take on that volatility. And for most people, the way they do that is just by regulating their initial investment. Like if your initial investment is not that much, kind of the mantra of don't invest more than you can afford to lose, then you will probably also be able to stomach the volatility. Or if you're lucky and you kind of get in at the bottom, then you never go underwater, so to speak. That's the ideal situation, obviously, if you invest right at the bottom and then Bitcoin only, it's very volatile, but it's always in the plus in dollar terms. That's, I think, very hard to obtain. Ideally, you want to pursue a combination of the two where, first of all, you think about how much do you want to invest in this market. And I think it's probably a good idea to approach it as some kind of insurance policy, like just how you get insurance against fires and theft and things like that. It's like an insurance for the rest of your portfolio. Like what if we have very high inflation in 10 or 15 years from now? How do I protect myself? What if there's another repeat of 2008 where there's all these things that are built up in the system that not enough people were aware of? What kind of asset would I want to own that could protect me against that? I think Bitcoin falls in that category, like next to gold, as like a hedge against systemic risk. And so do that first, decide on the kind of quantity you want to invest. And then secondly, you want to look at the cycle of Bitcoin and try to identify, ideally, I would say not exactly the bottom, but try to invest during the accumulation phase, which is usually when Bitcoin has had a big bear market, when retail is not interested at all, but when you see smart money at work, where you see infrastructure being built, where you see the price going sideways, ideally in a channel. I think those are the periods when you probably want to think about deploying that capital.
That makes a lot of sense. I liked what you said at first about this shift in mindset. I find it kind of interesting that most of, despite a large number of Bitcoin maximalists and, people who profess to be thinking in BTC, there aren't a lot of websites that will price crypto assets in BTC. There's not a lot of accounting solutions that allow you to denominate in BTC. And there's not a lot of people who could tell you how much a cup of Starbucks coffee costs in BTC or Satoshis or what have you. So it does seem like there's a bit of a Copernican shift in our financial world that needs to take place super early between thinking of USD or whatever our local fiat is as the center of our financial world to thinking around Bitcoin or whatever your favorite cryptocurrency is that a switch that you've made with regards to like your personal accounting and thinking? What's your sort of unit of account as an investor?
I would say by and large, no. Like I have no idea what my utility bill is expressed in Bitcoin, for example. And I do think very long term, we could be heading in that direction. where Bitcoin becomes basically a unit of account aside from a store of value and the other functions of money. But I think like in the short term, basically when people think about Bitcoin accumulation, what you're doing is benchmarking, really. I mean, it's so common in the fund world to have a fund that is benchmarked to the S&P 500 or benchmarked to global stock markets. And then the goal is to outperform that. It's just really, really common. And so that's kind of how I think it's useful to look at it. It's like, well, once you believe that, Google is the search engine that's going to dominate, then rather than investing in a basket of search engines in, 1994, 1995, which there were dozens of search engines back then, you could say, well, I'm just going to hold Google as a kind of core value in the search engine market niche. And then together with a few others, maybe those together are going to be a benchmark for me. So maybe more recently, that would be like the FANG stocks or so. I mean, it's hard to come up with real analogies because, of course, Google is not a protocol. It's not like TCP/IP or the email protocol. Like it's really a private company, whereas the potential for Bitcoin to be a financial backbone is so enormous that I think thinking in terms of Bitcoin is probably more useful than thinking in terms of Amazon performance, because there's so many things that can cause a company to go off the rails that are less likely with a semi-ossified protocol like Bitcoin. Like Bitcoin is not going to change much. The only thing it needs to do is that continue to show that it's reliable and that things can be built on top of it for it to succeed long term, I think. Like just like, .com domain names, like the top level domain name space does not have to change much for .com to continue to be a valuable platform for you to register a domain name in. Because technically right now there's dozens. So nomics.com, you could register nomics.ind or whatever, but you chose .com because it's the standard and it communicates that, you are a serious business and all those kind of things. And so I think it'll be similar with Bitcoin.
I think that's a really interesting point. I once paid 7 figures for a .com domain name that was really, really difficult to get. And there was no differentiation with that domain name versus others that could potentially exist like .pizza or .blue or whatever it was, other than it was a .com. And so that's a really interesting point about value.
Just to kind of like continue a little bit, I would say is the fascinating thing with me is that top level domain names, it's completely flat. Like in terms of, there's no technical difference at all with a .ru or a .eu and a .com. Like it's exactly the same technology, just like how a lot of the altcoins are almost identical to Bitcoin. The only thing is that there's this kind of reputational snowball that has created more value and has made the market more valuable, and thus created a kind of a barrier to entry so that you have to put more money on the table to buy that .com, which means that you probably need some kind of long-term plan with that name to execute it, which you don't need if you only pay $10 for nomics.eu or something. And that is like a label of quality. Like it communicates to the rest of the world, to strangers, like, oh, this guy has this expensive domain name. He must be serious about this. And so it's the chances lower that this is just a random scammer. And I think it'll be similar with Bitcoin. Like, oh, like this merchant is, or this product is built on top of Bitcoin. They must have thought about this to be willing to, I think Bitcoin fees are going to go up. It'll be $10, $100 for, transacting on the Bitcoin blockchain, I think, in the long run.
Going a little bit back to Bitcoin being at the center of the financial universe and benchmarking yourself against it. I think benchmarking is one standard, saying we're going to measure returns against the returns we would have gotten if we just invested in Bitcoin and held. For you as an investor, is investing for Bitcoin accumulation, is that really just investing against a Bitcoin benchmark, or is it truly about accumulating more BTC? Because I think there is a difference.
I would say that the difference is if you had an offshore fund where there was just zero taxes to be taken into consideration, those would be pretty much identical. But if you're a Bitcoin benchmarked fund and you do all kinds of things under the hood that will generate a lot of taxes for your investors, it's possible that when all is said and done, they will actually lose Bitcoin, even though the net performance shows positive, is kind of benchmark outperformance. So yeah, it's something that you have to really take into account when you think about investing for yourself. It's like, it's a big difference before and after taxes. And so you have to even take into account what state do you live or things like that when you want to think about accumulating more Bitcoin. Like, what is the particular activity that I want to do and how is it seen by the IRS, or is there any guidance already, which is often a challenge. And so it's understandable that for a lot of people, the safest route is just to say, look, I'm gonna hold on to my Bitcoin and I'll just ride that wave without risking losing my stake, so to speak, which is totally understandable. Like you said, it's very important to make that distinction. It's depending on the tax situation, it can be a huge difference between Bitcoin accumulation versus Bitcoin benchmarking.
What about in terms of infrastructure and services that are available to people who do invest for Bitcoin accumulation? Like hypothetically, if someone were to have a fund that were denominated in BTC, are there even like fund administrators that will do accounting that way and report assets under management back to LPs in BTC? Do you know what exists there and how hard that kind of thing might be?
My experience is that administrators, you want to find an administrator that has experience in the space, but ultimately accounting will happen in dollar terms. It's just a matter of translating everything in a good way. That's not making the difference to the bottom line or to the actual tax situation. It's just how you denominate things. What matters is what assets move, what assets are being sold. How things are denominated isn't going to make the biggest difference. But of course, you want for your administrator to be aware of what's happening and what the benchmarks are and what the strategy and the structure is. But so yeah, I would not be comfortable to work with an administrator that doesn't have any experience, where the education has to start from scratch. That would not be the way to go. And I mean, and there's been Bitcoin funds for about 5 years now, so there's definitely quite a bit of experience. Once you start looking around, you can find those partners.
Well, that wraps up part 1 of my conversation with Tuur Demeester from Adamant Capital. I hope you'll join us next week for part 2, where we discuss the methods used for investing in Bitcoin accumulation and hear Tuur's take on Ethereum and the future of Bitcoin. Until then, take care.
That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.